Okay, welcome. Weekly roundup. Mid-month, July 15th, 2022.
Yes.
To think there for a second what year we're in. Eh? We were just talking about interest rates and what week it was, and I can't even keep the years straight here. Yeah, crazy bit of a, I want to say a crazy week, but not, things that have happened, but not that untypical for this, for the last little bit here, right? These times. I mean, the news is trying to be optimistic here. The breaking is Dow pops more than 600 points in a relief rally Friday, but closes with weekly losses.
Yeah.
Right?
They like to be dramatic on both sides. Up, down, dramatic messages for you to read the comments.
It gets me every time.
Exactly.
All right. Well, yeah, lots of things went on today. Why don't you start off by what grabbed your attention?
Sure. I mean, obviously, when we spoke last Friday was what was the Bank of Canada going to do this week? And we saw what they did is they raised rates 100 basis points and surprised the market. As we came into that, it was 100% chance that they raised 75, and then they came out with 100 with 1%. Mm-hmm. And so what that did with the U.S., because their meeting is on the 22nd, or 27th, excuse me. So that went from prior to the meeting, they had somewhere in the neighborhood of a 20% likelihood of a 100 basis point raise in the U.S. That number's up to about 85% likelihood now that they're going to raise 100 basis points in the U.S. And so, continue to have lots of conversations with people around, what does this mean? And what does this mean to portfolios? And so as a quick refresher, the banks control the front end of the bond curve. They control kind of 0 to 18 months, we'll say. So even though they're pushing rates up, the bond market is still saying, we agree with you now. We understand that you're going to put the economy into recession. And so we've seen bond yields since June 14th, prior to the previous meeting, haven't been retested yet. So what's happened is those 2-year bond yields are higher than the 10-year bond yields. And so in the US right now, that's about 0.25%. And that might not sound like a big number, but it's a giant number. I think in the worst case of 2008, we got to 70 basis point spread there, but that was briefly. So it's a pretty big spread. And why does that matter? Every time historically we've seen the 2-year higher than the 10-year, we've either been in a recession or heading towards one. And so that continues to point towards my view that I think we're in one. And now the depth of it is more the question than whether we get there or not.
Yeah, definitely. Did you have so you think we're in a recession there right now?
Yes.
Any theories on the depth or or timeline?
Mm-hmm, mm-hmm. So I read the Bank of Canada put out their MPR, which is kind of the monthly report on what's happening in the world. Kind of read through most of their comments, and you try to digest what they're looking at, what they're seeing. You try to compare it to historical events like 2018, 2015, 2008, 2001. You go back through history and look at the similarities. And so, I think one of the things that it's hard sometimes to look at it and say, well, we got inflation printing at 9.1% in the US. It's impossible that it's going to go down. And so I think the answer is it has to go down. And the pace at which they've tightened interest rates, which one of the slides I'll show quickly, is the fastest in history. So I think there's a high probability that we get a really quick slowdown in inflation. And there's a possible risk that next year we get deflation, which is hard to believe at this point. Mm-hmm. But I think the depth of it is going to matter in the kind of the last 2 quarters of this year, probably November, December, when we'll see the effects of it dramatically into the economy. One of the interesting things I was looking at was just oil obviously it's the only thing that hasn't contracted, where, copper's down 40%. And copper's been pretty good litmus gauge for where the economy's at. But oil's the only one that hasn't rolled over. And when you look at the comparison with oil and DXY, like the US dollar, if we didn't have the war going on right now, that US dollar oil connection would kind of put oil somewhere in the mid $20 a barrel range, and we're up at 100 right now. So, I think that that things roll over pretty dramatically from an inflation perspective, and it's because they've gone so fast. I think there's a pretty quick reaction to that into the economy, and then how deep do we go? Well, unless the central bankers have completely changed, or they want to put us into a deep recession, they're going to cut rates and stimulate the economy again. So, when's the timeline of that? Well, jumping past one of my slides here, but the futures market's already saying they're cutting rates in 2023.
Okay, good.
Yep.
Good. That was a long way to get to 2023. It's good though.
Sometimes there's too much going on, and I have to share it. I know everyone just wanted a simple answer, but I extended it a little bit. Need some data
funny.
to back it up.
So anything material in the portfolios this week, or just still kind of holding tight till we see a brighter future here?
Well, holding tight. As I say, bonds are continue to show good signs, and on a day where you get the Dow up 600 points, well, bonds are also up today. So the market, at least the bond market, since June, a month ago now, I guess, we haven't retested those lows, and I think those probably were the lows in middle of June. And so I still think that works quite significantly in the second half of this year, where government bonds can rally. But the other thing that's popped up this week and that's been coming on recently is, like, I look at what are the 52-week lows of stock prices in Canada. The second one on the list is Royal Bank. So you look at some of the big names are starting to touch 52-week lows here. They're starting to say, okay, like, this is real.
Right.
And so these are important things to watch. And there's going to be some great buys, as I've been saying in the daily here. And some of those names are getting pretty attractive. It's just, what I've commented on is, do you want to own this for 6 days or 6 years? 6 years, it's in the really attractive zone. 6 days or 6 weeks, well, we'll continue to watch and take our time there.
For sure.
Yeah.
Okay. Sounds like you get some interesting slides here. So why don't we get to those?
Yeah, I think I gave them all away at this point.
I know. It's okay. It'll be good for us visual learners.
That's right. Good point. Good point. So this I've commented on a little bit in the daily, just around how much of the money went into variable rate mortgages over the last number of years, particularly since the start of COVID. So this is really, that blue line is showing the discount on variable rate mortgages, and showing how deep those discounts were for people. And the yellow line is the share of mortgages that were variable rate. So you're looking at kind of 50%, as I mentioned, have been variable rate mortgages. And so they would feel the effects more, of course, on this spiking of interest rates. And so as we spent some time in the banks, we're seeing it now as people are really anxious and worried about, well, like, what this means, what they should do. Should they lock in? Should they do this, do that? But we're seeing kind of massive pressure on those variable rate mortgage products.
Right. Yeah. It's a good one.
So I thought this was an interesting slide too, because I have had questions about inflation. People say, where is it coming from? This was a great breakdown from Josh Steiner at Hedgeye. And so you get a side-by-side comparison, really, to see where the pressure is coming from. And when we look at it on this scale, food was a significant uptick in pressure, and then energy, of course, was the biggest. So I'd say housing and energy were the two major inputs for higher CPI than expected, and this is both in Canada and the U.S. And so, interesting note where we've had this kind of this upward pressure in used cars over the last 2 years. We've seen that correct dramatically. And so used cars prices have slowed significantly, and that's going to kind of fizzle out here over the next couple of months because prices have come down quickly. But I'd say energy and housing are kind of the two upward pressures, particularly in the US. And in Canada, less so, but it's interesting where it's coming from and worth watching. But energy seems to be that continued wild card.
Good, yeah, very interesting. 2 for 2, Ben.
All right.
I think I got 3 for 3.
I think I got 5, but quick today. Quick.
5.
Quick.
Okay.
So this is the rates because people say, like, when do they start to pivot is the kind of the question that I'm getting more than anything now. And so this is since 92, just to give you a sense of how much they've tightened and how much they tightened. So this is in kind of 93, 94, they tightened rates 240 basis points, 180, 118, 100. And now we're at 270 with the likelihood that they go again next week, or sorry, in a week and a half. So it just shows you the pace and how steep it's been. I think in all of these cases we had a recession, but it's important just to pay attention to the speed at which that's moving.
It's crazy, yeah.
So this is the kind of the primary question I get from everybody. I get conversations about what's happening in the future, because right now we sit here and you listen to the bank talk, you listen to the central bankers, they all say rates are going higher, and we don't disagree with them at this exact juncture. But what this is, I know maybe it's a little bit dark here, I see, but this is from Cantor Fitzgerald, which is just showing you that, the presently right now says that the Fed will cut 75 basis points in 2023. And so really it's telling you the economy is rolling over. They think inflation's rolling over. The Bank of Canada has said in their reports that they think inflation's rolling over as well the next year. So at some point, the market will fully price this in. I think bonds have already agreed. Stocks, I don't think have agreed just yet, but it's coming. So interesting, looks like rate cuts are in the future. And I think that's important to pay attention to.
Yeah, really good.
Okay, last one. And this is from, it's not a new one, but for those who didn't see the semi-annual presentation, and it's just a kind of a reminder of what that can mean from a portfolio return perspective. If we have another 84 and another 2018, then we can, go back and look at the 70s and the 40s as well if you want to. But these are kind of recent events where we've had high inflation with tightening financial conditions into that. And so 1985 was the year after this happened when they started cutting rates. And so, stocks are up 30+%, bonds up 25. 2019, again, similar. You had a big move up in equities and a big move up in bonds. So these are important kind of forward-looking things to think about as we make our way through the summer and the fall. And as stocks come down, I think this is an important thing to remember why and how and what we're doing when we're investing into these kind of bear markets that we're in right now.
Okay, great.
That's it.
Yep.
Yeah.
5, eh? You're right. They just went by quick as can be.
That's
all right. So what are we looking at for next week then?
Yeah, so as I've said over the last couple of weeks, I continue to watch quite closely as these stocks come in, and as I mentioned, the banks and the insurance companies, and some of these are coming down to 52-week lows. Starting to pay 5, 6, 6.5% dividend yields. Like, these are things that we need to pay attention to right now. More than anything, though, let's see what the follow through is from this week. I think this was probably short covering into today, but the trends continue to appear to be lower highs in the stock markets, and so I would say we continue to watch that. central bank's going to raise rates at the end of this month, U.S. central bank. So we'll continue to watch that and see how that plays out. But probabilities increased dramatically with 100% basis point increase in Canada this week.
Right. Anything else you want to touch on before we go? Actually, last chance to get in a quick question if anybody wants to. But anything you want to touch on before we go?
I think the one thing I'd just like to touch on from a market perspective is we have had questions about gold because it's been kind of stuck in this neutral range. Inflation's high. It continues to be one of the questions I spend a lot of time with. What's happening to it at this point? So it continues to be stuck in this kind of sideways range, and so nothing really has changed for it. But I've had lots of questions about that too. And so we'll continue to watch that, but nothing to change at this point. I'd say the last thing I'd leave on is just, we are having lots of conversations with clients right now, talking about, if you have additional monies, where we should be looking to deploy it. I do think there's lots of opportunities here and coming. So feel free to either just book a meeting through our booking app or reach out to Scott or I, and we'd love to connect.
Yep, that's a great point. Great point.
Yeah.
Okay, everybody, thanks for joining, and have a great weekend, and we'll see you next week.
Sounds good. Thanks. Take care.